Welcome to Crisis in Perception, where we examine the systems shaping our world one book at a time. Today, we're diving into a really essential work by Grace Blakeley, Stolen: How to Save the World from Financialization.
It's a crucial read.
It really is, because when we talk about the modern economy, the language we use is always so clinical, isn't it? It's technical, it's framed as neutral.
Completely. We hear about GDP, interest rates, trade deficits, and you're led to believe these are, I don't know, natural forces.
Like the weather or something. Something you react to but can't really control.
Exactly. When in reality, these are all the outcomes of very specific political and structural choices. Choices made by, powerful people over decades.
And that perceived neutrality is really the core misunderstanding Blakely is trying to take apart, right?
That's the whole point. For most people, economics is this field run by experts, by technocrats, who are just managing these inevitable mechanisms.
And if something goes wrong, like a huge financial crash.
Well, then the conversation immediately shifts to technical failures.
Right.
Maybe things were too complex, or it comes down to individual morality.
The greed is good narrative. A few bad apples.
A few greedy bankers. It's always framed as a machine that just needs a couple of regulatory tweaks, a little fine-tuning, and then it'll run smoothly again.
But that framing is so effective because it completely distracts us from what finance actually is.
Which is?
A profound systemic structure of power. It's not just a collection of banks and stock markets. It's an entire logic, an entire operating system for organizing society, for allocating resources, and for deciding, ultimately, who wins and who loses.
Precisely. And shifting that perception is the real mission of this deep dive. Blakely's central argument, her whole thesis, is that financialization wasn't a series of, unfortunate technical mistakes that just happened to lead to 2008.
It was a project.
It was a deep structural transformation, a systemic political project that was carried out over the last 40 years to fundamentally change how our economy works.
Right.
And maybe, most importantly, to rebalance power decisively in favor of capital and away from labor.
So we have to see it as a political strategy first, and only then as an economic outcome.
That's the key.
Okay, so let's start by introducing the author who's our guide through this, Grace Blakeley. She's a prominent economist, a political commentator.
And she comes from a perspective that sees these issues as, well, inherently political. It's all deeply intertwined with power dynamics and, crucially, with class.
The book itself was written in a very specific context. Blakeley calls it the extended crisis.
Right, and she's not just talking about the immediate months after the 2008 crash.
No.
She's talking about the entire decade that followed, a period where that pre-crash model of growth, a model totally reliant on finance, had just visibly stalled. It completely failed to deliver rising living standards for most people.
So she sees this whole period as the death throes of finance-led growth.
That's her phrase. It means all the contradictions that were always there in the system, things like stagnant investment, rising debt, extreme inequality, they couldn't be hidden anymore behind soaring house prices or easy credit.
They were just out in the open, exposed and getting worse.
And while the book uses Britain as its main case study and goes into incredible detail about the UK's transformation, the lessons are much broader.
Because this model, this highly financialized model, is most visible in what she calls the peculiarly Anglo-American growth model.
That's the nexus, for sure, the US and the UK. But we saw so many other economies jump on board. Think about Iceland and Spain right before 2007.
Total adherence to the model.
Absolutely. And it's still incredibly strong today in countries like Australia and Canada.
Yeah.
They're very much following that same playbook.
But why is the British case such a perfect blueprint for understanding this?
Well, because in the wake of that 1970s crisis, Britain arguably went further and faster than any other country in deregulating its financial sector. It just went all in on this finance-led model.
And the whole economy transformed.
Incredibly quickly. It became defined by, really, three key features. One, an oversized and politically dominant finance sector. Two, a chronic, steady erosion of the share of national income going to wages.
And the third...
An economy where growth was driven almost entirely by an explosion in household and corporate debt, all propped up by a massive, persistent current account deficit.
Okay, so let's try to articulate the book's central and, honestly, quite chilling argument. It's about more than just the financial sector getting bigger.
Oh, much more. That's the key definition we have to get right. To really grasp the scale of the shift, we have to look at what was displaced, what was lost.
And that was?
Productive investment. Financialization is a systemic pivot away from the activity of genuinely creating new things, making new goods, expanding productive capacity, developing new tech, offering better services. All of that gets pushed to the side
In favor of what?
in favor of rent-seeking, debt dependence, and purely speculative growth.
So the whole goal of the economy changes. Profit isn't generated by making something new or better.
No. Profit comes from extraction. It comes from owning things that already exist, from controlling access to scarce assets, from imposing fees, or just from lending money at interest.
And Blakely has a chilling phrase for the system. She calls it capitalism's most perfect incarnation.
It is chilling. And why perfect? Because it's perfectly designed to maximize returns through what she calls financial extractivism.
Which is just siphoning wealth.
Siphoning wealth from the productive parts of the economy, from workers, from innovative businesses, and channeling it directly into the hands of asset owners and financiers. It's an engine built for one purpose: continuous wealth transfer upwards.
Okay, so to really unpack how this transformation happened, we need to go back in time. We have to look at the world that the financializers wanted to disrupt.
That takes us to the end of the Second World War, specifically to the Bretton Woods system, established in 1944.
And this wasn't some kind of, natural evolution of the economy.
Not at all. Bretton Woods was a conscious, deliberate political project. It was born from the trauma of the interwar years, the chaos of countries devaluing their currencies against each other, the rise of speculation, and of course the Great Depression.
This is where John Maynard Keynes comes in.
Right. Keynes, representing Britain, argued very forcefully that to have any kind of post-war stability, the state had to reimpose discipline on the wealthy, specifically on the rentier class.
The people who just profit from lending and speculation.
The ones who profit from owning things, not making things. He saw them as inherently destabilizing.
So the system they designed was all about constraints. It set up global currency pegs with the US dollar tied to gold. But the really crucial part, the thing that defined that post-war golden age, was capital controls.
Yes, the capital controls. You can think of them as fences, really.
Yeah.
They were designed to stop what was called hot money. These massive volatile pools of private capital that just fly around the globe looking for a quick speculative profit. By limiting the mobility of that capital, they stopped banks and speculators from causing these wild, destabilizing swings in exchange rates.
And it allowed governments to focus on their own domestic economies.
It protected their ability to pursue full employment and public investment without fearing a speculative attack on their currency.
So what was the result of putting these political fences up?
The result was, well, profound stability for about 30 years. Because the rentier class was contained, the focus of the economy shifted to the real stuff, producing, selling, distributing goods and services.
And that had huge social consequences.
Massive. Inequality fell sharply, and crucially, for the first time in a long time, wages generally rose in line with productivity gains. Workers shared in the wealth they were creating.
So this political settlement, backed by a state committed to Keynesian demand management,
using public spending to boost demand, keeping interest rates low.
It created this unprecedented social stability we remember from the post-war decades.
It did. But those constraints, the very fences built to protect national economies from global finance, they started to fray in the 1960s.
The crisis of the 1970s didn't just appear out of nowhere.
No, it was undermined.
Yeah.
And it was undermined by clever, or maybe cynical, moves from the financial sector itself. The most important of these was the emergence of the unregulated eurodollar market.
Okay, this sounds technical, but it's a really critical piece of the puzzle.
It's the mechanism that broke the system. It started quietly, around 1955. Banks in London, like Midland Bank, they realized they could take deposits denominated in US dollars and pay interest on them.
So what?
The key is that they were doing this outside the jurisdiction and regulatory control of the US Federal Reserve. They essentially created a parallel, offshore, unregulated market for the world's reserve currency.
And how did that drain power from the Bretton Woods system?
Well, the U.S. was spending huge amounts of money all over the world at the time. The Vietnam War, domestic programs. Trillions of dollars were flowing offshore.
Right.
So when banks in London started trading those dollars freely, with no restrictions, it created this almost bottomless pool of global capital that Keynes' system was never designed to handle. It massively empowered financiers in the City of London, giving them resources governments couldn't even track, let alone control.
And that slowly chipped away at the foundations of the fixed exchange rates.
It made them harder and harder to defend, and at the same time you had the rise of huge multinational corporations.
And they weren't just trading goods anymore.
No, they were moving billions of dollars of capital around the world internally between their own subsidiaries to optimize their tax bills and operations. This huge private movement of money just strained the fixed-rate system to its breaking point. The whole thing was leaking like a sieve.
Then comes the final blow. 1971. The U.S. had been printing so much money there was a global dollar glut.
And other countries, especially France, started getting nervous about inflation. They began demanding that the U.S. honor its promise to exchange their dollars for physical gold.
And Nixon's response.
He unilaterally ended the dollar's convertibility to gold. He just closed the gold window, and in that moment, Bretton Woods was effectively dead.
And the world learned a fundamental truth about money.
It learned that the dollar's value wasn't based on a commodity like gold. Its foundation was sheer American economic and imperial power, backed by a global consensus to use the dollar for trade and debt. Money was now purely fiat, just a promise.
The end of this international system happened to coincide with massive domestic instability, especially in the UK and the US. The dreaded stagflation.
You're right. Rising inflation and rising unemployment at the same time. This was a nightmare for traditional Keynesian policy, which is built on the Phillips curve.
The idea that there's a trade-off. Low unemployment usually means high inflation and vice versa.
Exactly. Stagflation broke that model.
Yeah.
And this exposure of the acute strains in the social democratic model, as Blakeley calls it, it created a zero-sum conflict.
A battle.
A real battle. On one side, you had capital. Their profits were being seriously squeezed by international competition, rising energy costs from the oil shock, and high inflation. On the other side, you had a highly mobilized, powerful labor force demanding wage increases just to keep up with the soaring cost of living.
So the big political question became, who would the state side with, capital or labor?
And this is the moment of the radical political pivot. The crisis of the 70s became the perfect political opportunity for a group of thinkers who had been waiting in the wings for decades.
The neoliberals.
The neoliberal agenda, patiently forged by intellectual groups like the Mont Pelerin Society. For them, strong unions and state intervention weren't stabilizing forces. They were mortal threats to freedom and, of course, to profitability.
So under figures like Margaret Thatcher in the UK, the strategy was overt, it was political and intentional?
Absolutely. The plan was to use the crisis to permanently institutionalize a new model that would systematically rebalance power back toward capital. And the first, most vicious target was the power of the unions.
They waged what Blakeley calls a war on labor, and their main weapon was monetarism.
Monetarism was the new economic orthodoxy. The idea was that controlling the money supply was the only way to control inflation. It completely dismissed the Keynesian focus on managing demand.
But in practice, what did that mean?
In practice, the weapon of monetarism was sky-high interest rates. Thatcher famously raised the base interest rate to 17%.
17%. It's hard to even imagine the political will to intentionally slow down the economy that much.
The effect was immediate and brutal. Economic activity was strangled. Mass unemployment returned, reaching levels that didn't fall below 3 million people for years.
And this wasn't some unfortunate side effect. This was the goal.
It was a deliberate strategy to break the power of organized labor. By creating a huge reserve army of labor, millions of people desperate for any work, you ensure that workers can't demand higher wages or better conditions. It completely crushed their bargaining power.
So this action, which was framed purely as a technical, necessary war on inflation,
A neutral economic goal.
was actually a highly effective political program to redistribute wealth away from workers and toward asset owners.
Precisely. And once labor had been disciplined, the government moved to empower its chosen successor, finance. This all culminated in the Big Bang of 1986, the radical deregulation of the City of London.
And this was much more than just a little bit of tinkering.
It was a revolution. The Big Bang abolished fixed minimum commissions on stock trades, which made trading much cheaper and caused volumes to explode. But crucially, it also eliminated the rigid separation between different types of financial firms.
The old distinction between, say, a stockbroker and a market maker.
Right. That separation had been there to contain risk. Getting rid of it and inviting massive foreign investment banks into the city just unleashed global finance on an unprecedented scale.
The immediate impact must have been huge.
Staggering. Trading volumes nearly doubled almost overnight. It created unbelievable new wealth for institutional investors and financiers.
So this moment really cemented the City of London as the global hub for financial speculation.
It laid the deep structural foundation for the next 3 decades of finance-led growth. The state had made its choice. It was now officially prioritizing the interests of mobile global capital over the stability of its own domestic industrial base or the well-being of its workforce.
And this political pivot, it didn't just stay in the financial district of London. It quickly changed how every single business operated. This is what Blakeley calls the financialization of the corporation.
That's right, and it was all driven by this new ideology of shareholder value.
The whole corporate strategy shifted. The post-war model was retain and invest.
Keep profits inside the company. Use them to expand production, hire more people, invest in R&D.
And the new mantra was,
Downsize and distribute.
get the money out of the company and into the hands of shareholders as quickly as possible.
Exactly. And this change was dictated by the growing, aggressive power of huge institutional investors. We're talking about pension funds, insurance funds, the new hedge funds. They controlled these colossal pools of capital.
And they weren't passive investors just waiting for a dividend.
No, they were activists. They demanded short-term maximization of returns quarter by quarter. And the central mechanism for enforcing this was simple but devastating.
Linking managers' pay to the company's share price.
Right. Suddenly, maximizing returns to shareholders became the sole corporate purpose. It trumped everything else: long-term investment, employee welfare, even the health of the community. The game wasn't about creating real future value anymore. It was about financial engineering to boost the next quarterly stock price.
The book gives the example of IBM, which is just a perfect illustration of this transformation.
It's staggering. In the post-war era, under its CEO, Thomas Watson Jr., IBM had a stakeholder model. They believed in looking after workers, managers, the community. They were driven by innovation. They worked on early machine learning, helped with the U.S. space program.
A genuinely productive company.
Absolutely. Fast forward to the 2000s. IBM's internal roadmap is no longer about technological breakthroughs. It's explicitly about how to boost its share price to $20.
And how are they going to do that?
Through purely financial means: mergers, acquisitions, and crucially, massive share buybacks.
Can you just quickly explain what a share buyback is for our listeners?
Of course. It's when a company uses its own cash reserves, not to invest in new equipment or training, but to purchase its own stock from the open market.
And why is that so significant?
Because by reducing the number of shares available, it artificially boosts the earnings per share metric, which makes shareholders very happy. It's a direct mechanism for distributing cash to shareholders that completely bypasses any form of productive investment.
And the human cost at IBM was huge.
Blakeley notes that employment in IBM's original headquarters town, Endicott, fell from 10,000 people to just 700. The resources were being systematically extracted from the workers in the town and sent directly to distant shareholders.
This extractive model wasn't subtle either. It was championed by figures like the corporate raider Lord Hanson.
Lord Moneybags. His firm, Hanson Trust, was the perfect embodiment of this ideology. Their whole business model wasn't about creating value. It was about finding underperforming assets.
So companies with good cash flow but maybe a disappointing share price.
Exactly. Hanson would buy them, load the company up with debt, and then start selling off chunks of it and aggressively cutting the payroll to generate cash.
All for short-term distribution.
Purely. When they bought Imperial Tobacco in 1986, they immediately sold off £2.3 billion worth of assets. And that money went straight to bondholders and shareholders as an immediate gain. It just proved that extraction was now a higher corporate priority than manufacturing.
And this shift had huge, measurable macroeconomic consequences. Long-term investment just stagnated.
The numbers are stark. UK companies' investment in fixed assets, factories, machinery, that kind of thing, it fell from about 70% of their disposable income in 1987 to just 40% by 2008.
And at the same time, corporate debt was exploding.
It grew from 25% of GDP in 1979 to a mind-boggling 101% by 2008.
And inequality, of course, followed the money.
Of course. The CEO to worker pay ratio shot up from around 20 to 1 in the 80s to nearly 150 to 1 by 2014. And at the same time, the wage share of national income, the slice of the pie going to workers, it plummeted from a peak of 64% in the mid-70s down to about 54% by 2007.
Okay, so within that rising profit share, Blakeley also points to a dramatic rise in something called economic rent. This is central to her argument about extractivism.
It's a critical concept.
Hmm.
Economic rent is any income you get from simply owning a scarce resource. It's income over and above what's needed to produce that resource or get it to market.
So it's unearned income.
Critically, it's unearned income.
Mhm.
Think of a landlord who just raises the rent every year without making any improvements to the property. Or a bank that charges high fees and interest simply because it has monopoly control over access to credit. It's a wealth transfer based on a power imbalance, not on innovation or productive work.
So the rentier share of national income acts like a drag on the productive economy. Blakeley notes this portion jumped from about 5% of UK GDP in 1970 to nearly 15% by 1990.
And this flow of rental payments to the already wealthy, it drains demand from the economy. The wealthy tend to save or speculate with extra money, not spend it on goods and services. This is exactly the low-wage, low-investment doom loop that Keynes warned about.
He famously called for the euthanasia of the rentier to save capitalism from itself.
He did. He saw this as a fatal flaw.
So all this rising inequality and wage suppression, it should have caused a massive crisis of demand in the 90s and 2000s. People couldn't afford to buy things. But the system found a way to paper over the cracks.
It did. The architects of this new model introduced something called privatized Keynesianism.
That's such a great term.
It's so descriptive. Because instead of the state stepping in with public spending to shore up demand, that's traditional Keynesianism, the new growth model relied entirely on debt-fueled consumption. Debt-led growth replaced wage-led growth as the main engine.
And how did that benefit the financiers?
From their perspective, it was ingenious. Private debt did two things at once. It propped up the economy by allowing people to keep spending even though their wages weren't rising. And it directed a bigger and bigger slice of household income toward interest payments, which generated immense, reliable profits for the finance sector.
And a huge amount of this was built on what Blakeley calls the housing asset trap.
The foundation of the whole thing, financial deregulation combined with policies like Thatcher's right to buy, which sold off public housing, it rapidly turned housing from a place to live into a purely speculative financial asset.
So you had this enormous flood of money into property.
A torrent of money, far outpacing the actual construction of new homes. And so prices skyrocketed. House prices increased tenfold between 1979 and 2008.
And this is where the political genius or cynicism of the system comes in, because those rising house prices created massive capital gains for middle-class homeowners.
It turned them into what Blakeley calls mini-capitalists. Their material interests suddenly aligned with the financiers. It persuaded them to support the status quo, even if their actual wages were stagnant, because they felt wealthy. Their paper wealth, their home equity, was constantly increasing.
But the experience was totally different for people who didn't own assets. The precarity of debt.
Radically different. This is illustrated so tragically by the case of Jerome Rogers in the mid-2010s. He was a 19-year-old gig economy courier in London.
So he was responsible for all his own expenses.
Everything. And he gets into trouble over a small 65-pound bus lane fine.
And it just spirals.
It doubles because of late payment. Then with fees and enforcement costs, it spirals to £1,000. So desperate, he takes out a high-interest payday loan.
Oh, no.
And when the bailiffs come to take his bike, the physical asset he needed to do his job, he was already paying more in debt repayments and expenses than he was actually earning. He tragically took his own life, completely overwhelmed by this unsecured, high-interest debt.
A type of debt which, Blakeley notes, has reached historically high levels since the 2008 crisis.
This individualization of risk is absolutely key to how the system works. For the wealthy, debt is leverage. It's a tool to get a low-interest mortgage, to buy more assets. But for low-wage workers, debt is a curse. It's an individualized source of desperation and exploitation.
And it forces people to focus on their own personal debt burden, rather than on, say, collectively organizing for better wages.
Exactly. It privatizes the risk of the entire economic system onto the shoulders of the most vulnerable.
So given all these dynamics, the corporate debt, the suppressed wages masked by household debt, the asset bubbles, the 2008 crisis really has to be seen not as some random accident.
Not at all. It was the inevitable structural crisis of financial capitalism. It was the logical conclusion. The contradictions of the whole finance-led growth model were just running out of road.
This is where we need to bring in the economist Hyman Minsky.
Yes. Minsky's famous insight, stability is destabilizing. He recognized that long periods of calm and prosperity in financial markets actually encourage more and more dangerous behavior.
Because investors get complacent.
They get overconfident. As they experience these long, stable returns, they feel comfortable borrowing more and more, assuming the good times will last forever.
Minsky charted this trajectory, moving from safe hedge finance
Where your cash flows comfortably cover both the principal and the interest on your loans.
to speculative finance,
Where your cash flow only covers the interest, so you have to keep rolling over the principal debt.
all the way to the final stage, Ponzi finance.
Which is the ultimate unsustainable cycle. You're taking out new debt just to pay the interest on your old debt. The assets themselves aren't generating any real return. Their price is being driven purely by speculation, by the assumption that there will always be a future buyer willing to pay more.
And the specific asset driving this particular Ponzi scheme was housing.
It was. The crisis was kicked off by the huge surge in subprime mortgage lending in the US and the UK. All of it was predicated on this catastrophically false belief that house prices would just rise forever.
But the mechanism that turned these local housing bubbles into a full-blown global crisis was securitization.
Securitization. The banks would take thousands of these really dodgy mortgage loans, package them all together into these complex financial products, mortgage-backed securities, and then sell them off to investors all over the world.
Often through the shadow banking system, so it was off their own balance sheets.
So they thought the risk was gone. They were basically selling the future income stream from these incredibly risky debts.
And the people selling these products claimed they were basically risk-free because the risk was diversified.
That was the sales pitch. But as Keynes pointed out decades ago, people constantly confuse quantifiable risk with unquantifiable uncertainty.
A crucial distinction.
Paramount. Risk is a measurable probability. You know the odds of rolling a 6 on a dice. Uncertainty is fundamentally unquantifiable. You cannot know what unexpected shocks the unknown unknowns might happen.
Like the entire housing market collapsing at once.
Exactly. The mathematical models they used completely failed because they assumed defaults would be random individual events, not a systemic correlated collapse.
So the crash was inevitable. The moment debt growth stopped and house prices started to fall in 2006, the whole house of cards seized up.
And when that shadow banking system froze, the first major sign of distress in the UK was the run on the bank Northern Rock in 2007.
The first bank run in Britain since 1866.
An incredible historical echo. Northern Rock had been so aggressive with securitization, borrowing short-term, often overnight, to fund long-term mortgages. When the other banks suddenly stopped lending to it because no one trusted anyone else's assets anymore, Northern Rock just couldn't pay its debts.
Blakeley draws a really powerful contrast between this failure and that previous one in 1866, Overend, Gurney and Company.
Right. Overend, Gurney, for all its disastrous failure, had at least lent money to productive, capital-intensive industries. They funded the railway network, physical infrastructure.
They built things.
They built things. Northern Rock, 141 years later, was largely creating debt so people could buy already existing homes, sometimes lending 125% of the property's value. It was pure speculation. And yet, Northern Rock was immediately deemed too important to fail.
Which brings us to the government response, led by Gordon Brown. It quickly became clear the banks weren't just illiquid lacking cash, they were fundamentally insolvent, bankrupt.
So the government stepped in with a colossal, coordinated bailout.
Historic in scale.
£500 billion in the UK alone, mostly injected into huge institutions like RBS, which had to be nationalized. Now, these actions did prevent a full-scale repeat of the Great Depression, but the lesson the public learned was deeply cynical.
The famous summary: socialism for the banks and ruthless free market capitalism for everyone else.
That was the logic. All the private losses, built up through decades of reckless gambling, were immediately socialized. They were transferred onto the public balance sheet to be paid for by taxpayers for generations.
And critically, the government didn't use its new ownership stakes to fundamentally change how the banks operated.
Not at all. There was no move to direct lending toward productive green industries, for example. The absolute political priority was always to make sure the underlying logic and power structure of finance-led growth remained completely intact. The system was saved, not reformed.
So after the financial system is rescued, the political narrative pivots on a dime. It goes from recovery to this urgent need for fiscal discipline. The age of austerity begins.
And it was all framed as an absolute necessity, based on this highly flawed analogy that a state has to behave like a household. You must stop spending more than you earn.
We need to pause on just how bogus that analogy is.
It's completely misleading. A state like the UK or the US, which controls its own currency, cannot go bankrupt on debt denominated in that currency. It can always create more money. Running a deficit to invest or stimulate the economy is a valid policy choice, a point that proponents of austerity just conveniently ignore.
Yet, this household analogy was deployed so aggressively. It was reinforced by academic research, like that infamous Reinhardt and Rogoff study.
Which was later found to contain a basic spreadsheet error, but it was used to justify George Osborne's rapid, deep austerity agenda starting in 2010.
So austerity was ultimately a political choice.
A profound political choice. It was designed to achieve three main goals. First, to reduce the size and scope of the state. Second, to shift the full cost of the crisis onto the shoulders of workers and communities.
And the third, maybe most important goal.
To keep labor in a position of subservience. By cutting public services and benefits, you make workers more dependent on their employers, which diminishes their ability to organize and demand higher wages.
And the social devastation that resulted from this project has been laid bare over the last decade. Blakeley documents some really severe outcomes.
The numbers are heartbreaking. 4 million children in poverty. Homelessness doubled between 2010 and 2016.
The statistics on life expectancy are just shocking.
They are. Life expectancy for homeless people in the UK has fallen to just 43 for men and 47 for women. Those are figures you'd associate with a developing nation, not one of the richest countries in the world.
And at the same time, the austerity era saw a huge rise in in-work poverty.
People who have a job but still can't afford the basics. And that was accompanied by the explosion of precarious employment models, the gig economy, zero-hour contracts.
Models that systematically strip workers of basic rights like pensions, sick pay, job security.
All in the name of maximizing corporate efficiency, which is just another way of saying maximizing shareholder returns.
And this relentless focus on cost-cutting isn't just an abstract economic failure. It had catastrophic, real-world consequences. The Grenfell Tower tragedy is the most horrifying symbol of this entire political economy.
It really is. The public inquiry laid it all bare. The decision to use cheaper, highly flammable cladding in 2012 instead of a fire-resistant option.
Because the safer option was deemed too expensive.
Grenfell just embodies the system's priorities perfectly. In the same year as the fire, the local council was celebrating giving a £100 tax rebate to its wealthiest residents. Their tax burden was seen as too high.
So when cost-cutting, driven by this relentless pursuit of efficiency and privatization, leads to catastrophic death and suffering.
It just underscores the systemic devaluation of human life when it's weighed against profit. The message, reinforced by massive cuts to social care while giving tax cuts to the wealthy, is that the deaths of the poor were a small price to pay for continuing the finance-led model.
Beyond the immediate human cost, austerity also eroded public wealth. The state just retreated from investment, and we saw continuous fire sales of public assets.
Privatization continued aggressively, often through these schemes called private financing initiatives, or PFIs.
And PFI was justified on these two bogus grounds, wasn't it?
Totally bogus. First, that it transferred risk to the private sector, and second, that it kept the massive upfront costs off the government's books, which played right into that false state as household analogy.
But the reality was the complete opposite.
The complete opposite. The private companies involved made sure the contracts guaranteed them high, stable rates of return no matter how bad the service was. The state ended up paying significantly more over the long term, up to 4 times the original build cost.
So the state took on all the risk, and the private companies got all the profit.
Exactly. Companies like the collapsed giant Carillion were basically running state-sponsored Ponzi schemes, just siphoning taxpayer money directly to executives and shareholders. By the 2010s, public investment in the UK had fallen to 2.6% of GDP, far below the OECD average. And that failure to invest is a long-term debt we are leaving for future generations.
Okay, so if we step back, we can really start to map out how this system, financialization, functions as a cohesive, self-reinforcing power structure. We've identified the key actors: the global financiers, the huge institutional investors, the corporations driven by shareholder value, and a financialized state.
And a prime example of that embedded power is the City of London Corporation. It's this arcane institution that functions almost as a state within a state.
It's the only part of the UK over which Parliament has effectively no authority.
Which gives it this unique structural position to lobby and ensure that the city's interests are always seen as being the same as the strategic economic interests of the entire country.
This inherent influence leads us straight to the narrative of illiberal technocracy. The shift toward rule by experts, independent central banks, a total reliance on opaque metrics like GDP growth. It had a specific political purpose.
It was a conscious move to take core economic decisions out of the democratic arena. Politicians could just throw up their hands and say, well, this is complex economics, it's a neutral science, we have to leave it to the experts. It provided perfect political cover for policies that fundamentally benefited asset holders.
How exactly did central bank independence serve this project?
Well, it was sold to the public as necessary because politicians supposedly have an inflationary bias. They might spend too much to get reelected.
Right.
But what it really enabled was for central banks to deliver the two macroeconomic conditions that investors love most. First, low consumer price inflation.
Which was secured by decades of union busting and cheap global supply chains.
And second, high asset price inflation, which was secured through ultra-low interest rates and quantitative easing.
So the average person might feel like their groceries were affordable, but the price of their biggest assets, their home, their pension, was constantly inflating.
Which secured the wealth of the asset-owning class. The central bank's policy was effectively captured by the finance sector, totally divorced from democratic accountability, all to ensure a wealth-generating environment for those who own wealth, not for those who earn it through work.
But despite all the staggering harm, the inequality, the volatility, the stagnation, the system somehow sustains itself. Blakeley calls this a carefully constructed sustainability paradox.
The political longevity is fascinating, and it relies heavily on co-opting a critical mass of middle earners. This is done by extending asset ownership to them, homes, private pensions, and encouraging what she calls the delusion of thrift.
So people are led to believe that their rising paper wealth is because of their own smart investment choices and hard work.
Not because of generalized debt-fueled asset price inflation created by the central bank.
And this creates a large voter base that has a material interest in protecting the status quo, even if it means their own children face worse economic prospects.
And crucially, the system uses debt, both household and corporate, to mask the inherent demand shortfall that's created by decades of wage suppression. Since you're not paying people enough to buy things, you just give them cheap credit and rising home equity as a substitute for wages so they can keep spending.
So the ultimate function is just a constant, reliable wealth transfer from those who live off work to those who live off wealth.
That's the core loop.
But even with all these stabilizing factors, the contradictions are becoming acute. There are looming global indicators that suggest this finance-led fix is running out of road.
That's the really worrying global picture. Investment and productivity growth have been slowing markedly worldwide ever since the crisis. This is an existential threat to capitalism, which needs rising profits and new markets.
And at the same time, global debt has just exploded.
The numbers are astronomical. Total global debt surged from $97 trillion in 2007 to $244 trillion in 2018. That's more than 3 times global GDP.
So you have this massive debt load combined with stagnant growth. That means markets are fundamentally overvalued and getting more and more volatile.
The indicators are all flashing red. We saw the longest U.S. equity bull run in history, but it's punctuated by these extreme volatility spikes. The inverted yield curve, which is a historically reliable predictor of recession, has been showing up.
And metrics like the Buffett indicator are signaling significant overvaluation.
The core message is that the ability of the financial system to generate paper wealth while masking the real economy's stagnation is reaching its physical limits.
So when we look back over this whole era of financialization, it's just depressingly clear what was displaced, what we lost in favor of financial extraction and speculation.
We lost productive long-term investment. We lost collective security through the state, socialized prosperity, not just socialized risk. And we lost any meaningful democratic accountability over the economy.
And any attempt at meaningful reform, even after a near apocalypse like 2008, is met with such fierce resistance.
A resistance that's often masked by the claim that there is no alternative, the cynical acronym INE.
And the power to enforce TINA lies with mobile capital, the so-called bond vigilantes.
Right. If a democratically elected government proposes policies that really threaten the status quo, like large-scale nationalizations or massive public investment or serious financial regulation, investors can just flee.
They sell off government bonds, the currency collapses, borrowing costs skyrocket.
And the government is forced to get back in line with market logic. It's exactly what happened to Mitterrand's socialist government in France back in 1983.
Which means, as Blakeley argues, that the path forward requires a fundamental shift in the battle lines. It can't just be about redistribution, taxing the rich a bit more to fund services. It has to be about ownership.
A focus on expanding state, community, and worker ownership is the only way to permanently shift the balance of power away from financial capital. And beyond that, she emphasizes that the very policies we need to tackle existential threats, like climate change, they demand massive state intervention and public investment on a scale that fundamentally threatens the existing power relations of finance-led growth.
So the entire project of saving the world from financialization has to be at its core political. It has to be a radical, intentional rebalancing of power away from capital and towards labor.
And the sources make it clear that this current period of extended crisis, defined by stagnation, rising debt, environmental collapse, it represents a revolutionary moment. The old logic has been brought into question, creating a moment of real contingency, real uncertainty.
So the question for you, the listener, is whether the elites will successfully use this moment to secure a new, equally contradictory order that just maintains their power through new forms of extraction, or whether a sustained political movement can seize this opportunity to institutionalize a new settlement. One that works in the interests of those who live off work, transcending capitalism's inherent tendency toward chaos. We are finally asking the question we are ordinarily not allowed to ask: what comes next?
This deep dive was based on the insightful and essential work of Grace Blakeley, author of Stolen: How to Save the World from Financialization. We highly encourage you to read the book yourself, support the author, or borrow it from your local library.
For a shorter visual overview of this topic, see the mini explainer linked in the description.
If you enjoy systems-level analysis like this, please like, subscribe, and comment with books or topics you'd like us to explore next.